Welcome to Matters Financial and Geopolitical from a Frontier. Hope the week's going well. I attended the Africa CEO Forum breakfast briefing this morning at the Serena, and the first observations about the hotel itself. They made some very interesting renovations, reinvigorating what has been an iconic brand here in Nairobi. And secondly, it was a really good function, lots of interesting people. Good to catch up with Brenda Mbathi, John Gumi, amongst others. Just hear people talk a little bit about challenges in Africa as we find it today. So thank you to Thomas for that invitation to that breakfast this morning. International markets, the IMF came out with the World Economic Outlook, which is an important report, comes out twice a year. The global expansion has weakened. Global growth for 2018 is estimated at 3.7%. as in the October 2018 World Economic Outlook forecast, despite weaker performance in some economies, and they're citing notably Europe and Asia, saying that the global growth forecast of 2019 and 2020 has already been revised downward in the last WEO, partly because of the negative effects of tariff increases enacted in the United States and China earlier. They also say risks to global growth tilt to the downside. An escalation of trade tensions beyond those already incorporated in the forecast remains a key source of risk to the outlook. Financial conditions have already tightened since the fall, they said. A range of triggers beyond escalating trade tensions could spark a further deterioration in risk sentiment with adverse growth implications, especially given the high levels of public and private debt. These potential triggers include a no-deal withdrawal of the United Kingdom from the European Union and a greater than envisaged slowdown in China. I like this. Idiosyncratic factors, new fuel emission standards in Germany, natural disasters in Japan, weighed on activity in large economies, but these developments occurred against a backdrop of weakening financial market sentiment, trade policy uncertainty, and concerns about China's outlook. They said this about China: high-frequency data signals subdued momentum in the fourth quarter. Global trade growth has slowed to well below 2017 averages. Growth in the euro area is set to moderate from 1.8% in 2018 to 1.6% in 2019. Growth forecast for the US also remains unchanged, expected to decline to 2.5% in 2019, soften further to 1.8% in 2020. Key sources of risk to the global outlook are the outcome of trade negotiations. And I said this 31st of December last year, I said the trajectory of the tariff war is another pivotal curve to keep an eye on in 2019. And on the 9th of July last year, I was asking tariff wars, who blinks first? Global growth projected to decline, as just to repeat it, to 3.5% in 2019. Currency markets, euro dollar 113.55. Dollar index 96.427, grinding higher. Japanese yen strengthening today, 109.41. Swiss franc 0.9976. The pound 128.76. I really thought Corbyn had threaded the political needle and was essentially going to go for a second referendum. And therefore I thought that was pound bullish, because he was then going to ride a youthquake wave, because if you look at the numbers, older folks want to leave, younger folks want to stay in, and I thought he'd tap into that enthusiasm. But clearly it still seems murky. Aussie dollar breaking down 71.38, India rupee 71.375, South Korean won 1130.77, Brazilian real 3.755, Egyptian pound 17.9237, South African rand 13.8836. The euro dollar chart, I think we're going down to 113. We'll take a look down there and then see what we do next. Commodity markets, gold, about which everyone had got very bullish, has come to 1279.39. I think it retraces down to 1260. IMF again, average oil prices are projected at just below $60 per barrel in 2019 and 2020, down from $69 and $66 respectively in the last World Economic Outlook. Of course, Saudi Arabia, they downshifted by 0.6% on GDP. Crude oil, this is currently at $53.27 versus their $60 or less average. Emerging markets, a second source of systemic financial stability risk, is a deeper than envisaged slowdown in China, with negative implications for trading partners and global commodity prices. Saying, nevertheless, notwithstanding policy-making responses in China, activity may fall short of expectations, especially if trade tensions fail to ease. As seen in 2015 and 2016, concerns about the health of China's economy can trigger abrupt, wide-reaching sell-offs in financial and commodity markets that place its trading partners, commodity exporters, and other emerging markets under pressure. 31st of December, I wrote about this. I said, high-frequency satellite data confirms a sharp slowdown in the Chinese economy, which is yet to be seen in official data points. The official GDP figures have been too stable in recent years to be a good guide to China's economic performance. Julian Evans Pritchard, the senior China economist at Capital Economics. Zhang Songzhu, a professor at Renmin University School of Finance, is at the controversial end of the spectrum. He told a seminar last month that President Xi Jinping's government was playing a game of smoke and mirrors. How bad are things? The number that China's National Bureau of Statistics gives is 6.5%. But a research group of an important institution released an internal report. Can you take a guess on the GDP growth rate that they came up with using the NBS data? Zhang said they used two measurements. Going by the first estimate, China's GDP growth this year was about 1.67%. And according to the other calculation, the growth rate was negative. Zhang is the former chief economist of the Agricultural Bank of China, one of the big four state lenders. Anxieties about rising unemployment were also evident from the slew of stats, with December's rate hitting 4.9%. And this reflects the human cost of the slowdown and the biggest concern that the Chinese apex government would have. Look at this chart, the endless devaluation of the Turkish lira in one chart, down 80% against the dollar over the last 10 years.